I often get asked the question of, I've got some money to invest, I'll put it away, I've got a residential property, I'm looking to invest in commercial real estate. What should I buy? The thing is, I come back to them, it depends. It really depends on the type of investor you are, how much risk you want to take. With all investment, whether it be the share market, commercial property, residential property, or whatever it may be, there's always an element of risk. And usually the higher the risk, the higher reward. And especially in today's competitive investment market, you've got to do some homework. You've got to either do your homework, know what you're doing, or work with someone who knows the business. And with commercial cap rates, there are reasons why they've changed over especially the last 10, 15 years, I've noticed, in the commercial investment market. The thing is, I've noticed there are certain top investment levels. You've got the lower level, which is usually $2 million below, which is the mums and dads, the single investors who've got usually invest in residential real estate, getting their 2-3% net return, or they may dabble into some commercial real estate, which is getting slightly more. Then you've got a slight gap. You go towards the $3 to $6 million mark, where you've got the large families, the small companies, the wealthy individuals. Then you progressed to the $10 million plus mark. This is the superannuation people, the trust funds. They usually work in $100 million lots. The funds are usually about $100 million. And they usually like to invest in properties worth $10 to $20 million. So they've got 5 to 10 properties they invest in, fairly easily to manage. As more and more funds are being put into these superannuation funds for retirement, the funds managers are getting more and more money to invest. We've seen it in the share market and certainly seeing it in the commercial real estate market. What's happened is there's a limited amount of properties in that $10, $20 million range plus. So they're running out of properties. They've got to invest their money. They've got these compulsory superannuation funds, retirement funds, and they've got to invest that money somewhere. So they may decide to go to the $5 million mark or $6 million mark, which means they're competing with that middle level of commercial investment market. The wealthy families, the wealthy individuals, the small companies. Consequently, they run out of properties available to buy and look for the smaller end, the $2 million below mark. They compete with the less wealthy mums and dads, less wealthy individuals, and consequently the returns are lower. Hence the situation where most people invest in residential property and they're getting 2-3% return. The thing is, what sort of return can I expect? What is a good cap rate for commercial real estate? Again, I refer to the risk-reward situation. For example, a good quality commercial investment, such as retail with a good tenant in place or industrial, is usually about the 4-5% mark. Over the years, they've been traditional investments in that initial market. That people know retail and they're getting to understand industrial more so. And lesser extent, which has changed over the last 4 or 5 years, has been the office market. Now, the thing is, what's happened? People were looking for good return, better returns from the retail market, the 4-5% mark. They were dabbling into the other markets, like the childcare market, childcare centres, retirement villages, boarding houses, accommodation, those sort of places. And what's happened, for example, childcare centres. 10, 15 years, you could buy a reasonable childcare centre for 6 to 8% net return. They've dropped down to about 4% return, sometimes even less. They're becoming more stable in investors' eyes than the banks were 10, 20 years ago, the supermarkets or the service stations. And you've got boarding houses too, another situation there. The yields have dropped down. You could get them to 10, 12%, 15% 10, 15 years ago. That's dropped down to about 6, 7% net return. So the returns are getting lower because of the pressure from the funds managers onto the middle level to the lower level. The question is, how can you get better returns? What is a good cap rate? Basically, you've got to take more risk. Instead of buying a childcare centre in the city, you have to go to the regional areas maybe, or commercial property in the regional areas. They're become more popular there. they're becoming more stable, do your homework, and the returns will be better. Then the thing is, what's going to happen? You can't afford to buy those large properties because the funds managers are buying them all. They're getting the better returns because they've got less competition. They can bargain harder. For example, an industrial property worth, say, $2-3 million might be selling for, say, 5%, 4-5% return. Whereas that higher level, that $10-20 million range, they could be getting up to 7%, maybe more. Where I see things happening is that there's more and more opportunities in buying properties which involve businesses, as we've seen with childcare centres, with pubs, accommodation places. What's the returns going to be there? If you're looking at 4% return for, the good childcare centres, the good retail, industrial properties, and you may get the accommodation like the boarding houses, 6-7%, that sort of thing. If you're buying a situation where there's a business involved with it, where you are the owner of the business as well as a property, you could be looking at around 10, 12, 15% mark. And maybe if you move out further into the risky areas, the regional areas, the country areas, you may get much more. And you're going to say, listen, I'm not an business investor, but most of them are managed and obviously they're not passive. I don't believe any property is passive anyway. Even if you buy a residential property in a great area, it's not passive. You can't just buy a property and just forget about it. You've got to be involved to some extent. So if the property may suit you where you can have more involvement in the business, you have a manager in place, especially if you've got some business background, it's certainly maybe worth considering. But it's good to work with someone who understands the commercial investment market and can help and guide you, because you may not be suited to buy commercial property. If you are, you're better off maybe buying a childcare centre with a fixed tenant in place, or a bank, or a service station, or a supermarket, that sort of thing. So the age and your experience does come into account. But if you've got some business knowledge, it's certainly worth considering getting into a business type of property. That's where I can see things happening in the future. Do your homework and the opportunities to be there. So if you're prepared to take some risk, that's probably a way to look at things. Less risk, you may look at things like boarding houses, and then you get all the way down to your blue chip, retail, industrial, that sort of thing. Or maybe you're not the sort of person to buy commercial property. Maybe a residential is the thing to go. If you don't want any risk or very less risk, you're happy with your 2-3%, sometimes lower return, and there's an opportunity for more capital gain, maybe residential is the way to go. But looking for a cap rate does take a bit of work, but the rewards will be there. Also note that the cap rates do vary with fluctuations in inflation rate, which are tied in with the current mortgage rates. So that should be taken into consideration as well too. I'd like to hear comments, and please subscribe to this channel for more videos like this. Thank you.